Your mortgage rate right now is somewhere around 6.5%. Nobody at your bank chose that number. The Federal Reserve didn't choose it either. It came from a market almost no one watches, a market most people couldn't name a single security in, and that market is currently worth more than $100 trillion. It sets your mortgage. It sets your car loan. It sets whether your company can afford to hire this year. And in 2022, it quietly cut this safe half of millions of retirement accounts by double digits in 12 months. Most people who own bonds have never once understood what they actually own. By the end of this video, you will. And you'll know exactly what every move in this market costs you in real dollars. Let's start with the simplest possible definition, because everything else in this video is just this one idea, scaled up. A bond is a loan. That's it. A government, a company, a city needs money. Instead of walking into a bank, they walk into the public and borrow directly from investors. You hand over a fixed amount, called the principal. In exchange, you get two promises. A fixed interest payment, usually once or twice a year, called the coupon, and your principal back, in full, on a specific future date, called the maturity. Lend me money now. I'll pay you interest every year. I'll return the principal on this date. That's the entire instrument. Nothing about a bond is complicated. What makes it powerful is scale. And no borrower on the planet operates at a bigger scale than the United States government. As of this month, the total U.S. national debt sits at roughly $39.7 trillion. That number is too large to mean anything on its own, so look at the interest instead. Just the interest, not the debt itself, runs at about $1.08 trillion a year. That's close to $3 billion a day, every day, whether the economy is booming or shrinking. That interest bill is now bigger than the entire national defense budget, and every dollar of it comes out of tax revenue, priced by the exact same market that prices your mortgage. There is one rule that unlocks the rest of this video, and once you understand it, you'll never look at a bond fund the same way again. When interest rates rise, the price of existing bonds falls. When rates fall, existing bond prices rise. They move in opposite directions every single time, without exception. Here's why. Say you buy a $1,000 bond paying 3%. That's $30 a year. A few months later, new bonds start being issued at 5%, paying $50 a year on the same $1,000. Now you want to sell your old bond. Nobody will pay you $1,000 for it, because they can go buy a new one paying more. The only way to sell it is to drop the price until your $30 a year works out to a competitive yield. At 5%, that price is around $600. Nothing about the bond changed. It still pays $30 a year. It still returns $1,000 at maturity. But on paper, today, your $1,000 investment is worth $600. Every disaster in the rest of this video is that one rule, operating at a bigger scale. Of everything trading in that market, one bond matters more than all the others combined. The 10-year U.S. Treasury. As of this week, it's yielding right around 4.6%. When a bank sets your mortgage rate, it doesn't invent a number out of nowhere. It looks at the 10-year Treasury and asks one question. Why would I lend money to a household for 30 years when I could lend it to the U.S. government for 10 years, essentially risk-free, at 4.6%? The answer is, it wouldn't, unless you pay more. So the bank takes that 10-year yield and stacks roughly 2 additional percentage points on top to cover the risk that you, an actual person, might lose your job, get sick, or default. Add that spread to today's 10-year, and you land almost exactly on the national average 30-year mortgage rate, sitting in the mid to high 6% range right now. Let's make that concrete. Say Sarah is buying a house and needs a $400,000, 30-year fixed mortgage. At a rate of 6.6%, her monthly principal and interest payment is about $2,550. Now imagine the 10-year Treasury climbs by half a percentage point. That's not a crisis. Bond yields move that much in an ordinary trading week. Sarah's mortgage rate rises by roughly the same half point. Her new monthly payment is closer to $2,690. That's $140 more every single month for 360 months. Over the life of the loan, that 1/2 point move in a market Sarah has never opened an account and costs her somewhere around $50,000. If the 10-year climbs a full point instead, also completely routine, Sarah's rate pushes towards 7.6%. Her payment jumps to roughly $2,830, and the lifetime cost of that one move crosses $100,000. Look at it another way. In January of 2021, the 30-year mortgage rate hit an all-time low near 2.65%. At that rate, Sarah's $400,000 loan would have cost her about $1,610 a month. By late 2023, the same rate had climbed above 7.7%. Same loan, same house, same buyer, monthly payment nearly $2,900. The only thing that changed was the yield on a bond she's never heard of. For decades, the standard advice for anyone approaching retirement was simple. As you age, shift out of stocks and into bonds. Stocks grow your money, bonds protect it. The classic 60-40 portfolio, 60% stocks, 40% bonds, was sold as the responsible, boring default. The bond side was supposed to be the seatbelt. In 2022, the Federal Reserve raised interest rates faster than at any point in over 40 years. Apply the one rule from earlier. Rates rise, bond prices fall. The broad U.S. bond market lost around 13% that year, its worst calendar year on record going back to the 1970s. The S&P 500 fell about 18% the same year, which means a 60-40 portfolio, the supposedly conservative default, lost close to 16% in 2022. The seatbelt didn't catch anyone. It was bolted to the same crash. And the losses weren't even. The longer dated the bond, the worse it got hit. Intermediate-term treasuries, the kind sitting inside most retirement target date funds, had their worst year in nearly a century. Long-dated, ultra-long duration treasury bonds lost close to 40% in a single year. One historical analysis of U.S. bond returns found 2022 was the worst year for long-duration government bonds going back to before the country existed. There is a single number that explains why some bond funds got crushed and others barely felt it. It's called duration, and it's sitting on the fact sheet of every bond fund you've ever owned, usually unread. Duration is a rough estimate of how much a fund loses for every 1 percentage point rise in interest rates. A retiree holding $500,000 in a broad bond index fund with a duration of 6 loses about $30,000 if rates rise 1 point. The same retiree holding a long-dated Treasury fund with a duration of 17 loses closer to $85,000 on the identical rate move with the identical amount of money. Same retiree, same dollars, same headline event, and $55,000 difference. And almost nobody who owns these funds has ever checked which one they're holding. Here's the detail that catches people off guard. If you own an individual bond directly and hold it to maturity, none of this touches you. The price can swing wildly along the way, and it doesn't matter because you collect every coupon and get your principal back in full at the end. You can ignore the whole rule. A bond fund is different. A bond fund never matures. It's a rotating basket of bonds, repriced every single day, forever. When rates rise, the losses show up on your statement immediately, and they stay there. The 2022 losses were real, and they did not quietly reverse when the calendar turned. Not all bonds carry the same risk, and the gap between them tells you something worth watching. Government bonds are considered close to risk-free because a government that borrows in its own currency can always print more of it to pay the debt back. Companies can't do that. Companies go bankrupt. So investors demand a higher yield from a corporate bond than from a government one to compensate for that extra risk. The gap between the two is called the high-yield spread. When it's narrow, the market is calm. When it widens sharply, the bond market is quietly telling you it expects trouble ahead, defaults, layoffs, missed payments, usually before that shows up in any headline or official economic report. The same mechanism runs in reverse when fear spikes. A war, a banking scare, a shock nobody saw coming, and investors dump stocks and corporate debt, then rush into government bonds. It's called a flight to quality, and it can push Treasury prices up and yields down within hours. This is also why stocks and bonds usually move in opposite directions, and why that relationship is what made the 60-40 portfolio work for half a century. The 2022 crash was so damaging precisely because the cause of the sell-off was rising rates, and rising rates are toxic to stocks and bonds at the exact same time. The hedge failed because the thing being hedged against had become the thing doing the damage. That same logic prices the entire stock market, whether you realize it or not. Government bonds offer a guaranteed yield. Stocks offer a higher expected return with no guarantee at all. The gap between what investors expect from stocks and what they could earn risk-free from a 10-year Treasury is called the equity risk premium. With the 10-year sitting near 4.6% and long-run stock return expectations around 7 to 8%, that premium is only 2 to 3 percentage points right now. When bond yields rise, that premium shrinks, and stocks start looking less attractive relative to a boring, guaranteed government bond. That's a large part of why stock and bond markets have been so tightly linked to Fed policy over the last few years. It isn't sentiment. It's arithmetic. There's one more shape worth understanding, because it may be the single best-performing economic forecaster in existence. It's called the yield curve, and it's just a simple plot of Treasury yields across every maturity, from 3 months out to 30 years. Right now, short-term yields sit close to 3.7%. The 10-year is near 4.6%, and the 30-year is around 5%. Plotted out, that line slopes upward, short maturities low, long maturities high. Economists call that a normal curve, and it's the shape the market takes most of the time, because tying your money up longer is riskier and investors demand extra compensation for it. Occasionally, that curve inverts. Short-term yields climb above long-term ones. When that happens, the bond market is making a very specific prediction. It expects the Federal Reserve to be cutting rates within a year or two because it expects the economy to weaken enough to force the Fed's hand. Research from the Federal Reserve Bank of San Francisco found that every single U.S. recession going back to the mid-1950s was preceded by an inverted yield curve. 10 recessions, 10 inversions. No other single indicator comes close to that track record. The bond market doesn't always shout its predictions, but when that curve flips, it's making one of the loudest calls in all of finance. And this isn't just abstract. It touches the cash sitting in your own bank account right now. The average national savings account pays somewhere around 0.4%. 3-month Treasury bills, essentially just as safe, are currently yielding closer to 3.7%. Same safety, same government standing behind both, one way or another. Wildly different return. On $20,000 sitting idle, that gap alone is worth well over $1,000 a year. Money most savers simply hand over to their bank without ever asking where it went. So what do you actually do with all of this? If any part of your retirement money sits in a bond fund, go find the duration number on its fact sheet. Anything above roughly 7 means that fund will move meaningfully every time rates shift. Anything above 15 will behave more like a volatile stock than the seatbelt it was marketed as. Knowing that number isn't optional if you own the fund, it's the whole ballgame. If you're holding meaningful idle cash in a low-yield savings account, understand that a short-term Treasury bill or a Treasury-focused fund is offering close to the same safety for multiples of the return, and in many states, without the added state income tax that ordinary savings interest carries. And if you ever hear that the yield curve just inverted, don't panic and don't ignore it either. Treat it the way you treat a genuine warning light. It doesn't tell you exactly when. It has an extremely good record of telling you that something is coming. The 10-year Treasury yield takes about 5 seconds to look up. When it climbs, mortgages, car loans, and business borrowing all climb with it. When it falls sharply, the bond market is usually bracing for a slowdown before anyone else is willing to say so out loud. It is the closest thing this economy has to a check engine light, and now you know how to read it. The bond market isn't something only Wall Street touches. It's the invisible machinery pricing your mortgage, your savings, your retirement, and the job market you work inside of. Every dollar in your financial life passes through it whether you've ever looked at it or not. The people who understand this aren't smarter than everyone else. They just stopped assuming it was too boring to matter.